which I'm hoping we have. There we go. Excellent. Right. So, Adam, first of all, can you hear me?
I can hear you fine, Tony. Thanks.
How comes you've had a haircut? No one else has.
I've done it myself, to be honest with you. I wasn't brave enough to touch the tops, just the back and sides. But yeah.
I'm actually going to join the 1970s tribute band once this is all over, because the way my hair's going at the moment, it's just getting absolutely ridiculous. It does feel like it was when I was at school in the 70s. I must start wearing platform shoes as well. So anyway, this is full speaker. You can tell I was doing this late last night. It's actually our first speaker is Adam Butler, Avamore Capital. You should have received this by email this morning, which is Avamore's product overview. And first of all, just a little bit about Adam. He works for Avamore as a relationship manager, previously working at Hampshire Trust Bank as a lending manager for approximately 18 months. Prior to that, he was a BDM at First for Bridging and also as a BDM for Vida Home Loans for 2 years. He started off in the finance industry as a mortgage broker, mainly in the residential and buy-to-let sector, and spent several years working for brokers such as Countrywide and Mortgage Advice Bureau. His interesting fact, Adam played against Christian Eriksen, the former Tottenham and current Inter Milan midfielder, in a European youth tournament in Denmark. His comment, not mine, is safe to say we all know who won that battle. I think probably Adam raised the white flag after about 10 seconds, if the truth be known. Because I've also played many years ago against a professional footballer, and I never wanted to play football again afterwards, because it just made me look even more stupid than I did when I played cricket. So, Adam, it's on to you. You now have control, and I will see you in about 20 minutes.
Brilliant. Thanks, Tony. And look, firstly, thank you to everyone. I know it's a bit madness at the moment, so look, really appreciate your time this morning, and really great to see the level of numbers we've got. I know some of you may have seen the name, but maybe not spoken to us before. Some of you out there may actually have not seen the name before. So firstly, really wanted to give you a quick overview of the company, background, and then the important stuff. We'll go through the products and how we can help you. So on the first slide we've got here, just a bit of background. So started in late 2015. So we just had our 5th birthday last year. Primary focus has always been bridging and development with 4 core products, which, as I say, we'll cover off in a little bit. Wider geography at the moment is something we're constantly working on, but at the moment we can go up to Manchester, Leeds, York and Harrogate as a northern boundary, and obviously right the way down through the south and Wales. It is something we're constantly working on. Some of you might look at that and think it's a bit of a wonky line across the country, and the reason for that is we want to really understand each micro location rather than just simply drawing a line and moving it up. Actually understand the micro locations within these towns and cities rather than trying to get to grips with them on your case. Let's understand them first, know what we're walking into, and then the service levels remain the same as something that we're really keen to continue. Team size, we're up to 20 people. I think that was a testament to where the company was last year, that we actually still hired 4 people last year. I was one of those joining in height of lockdown 1.0, I guess. So yeah, I think testament to where they got themselves into a secure position. And certainly growth is looking pretty strong for this year. We're already looking at potentially bringing on another 5 people in the first quarter. So company really is looking to grow. I suppose probably like a lot of businesses, had business plans for last year that had to be put on hold because of the pandemic. So yeah, I think hopefully really important. But I think for you guys, the important to note out of that 20 is of that 8 people are analysts and credit underwriters. So actually, when you look at that compared to larger firms, the 100+ lenders that you may work with, we're actually very much in line with the number of people who can actually get involved in the deal, underwrite the deal and progress the deal. So we may be smaller than others, but actually in terms of our ability to maintain those service speeds, which is vital in the bridging and development world, we really can. And as I say, we're looking already at 2 more underwriters to join Q1. So I think that's a big part of our service. You can see loan book, that was as of last week. I think we're just shy 260 now. But again, I think that's really going to look to ramp up this year with sort of targets of 150 million for the company for the year. So you can see that real ramp up. I think we're at that. Last year was a bit of an interim phase of growing, and as I say, I think hopefully a really strong year for us this year. The core products, as I say, we have 4 core products. Residential bridging, refurbishment and conversion products, ground up development, and our Part Complete scheme, which is really our flagship product that allows us to step into Part Complete product developments, refinance the current lender and actually fund the remaining build cost as well. So we'll come into that in a bit more detail, but that is something that we've done right from day one. It's a very unique offering, and I think, you know, it adds a string to your bow when you're going out speaking to clients. You've got something very unique there in your armory to be able to offer, and I honestly believe that will be a strong product this year, with a lot of developers struggling last year with factors on site. I think speaking to guys already this year, Brexit has had a bit of an impact on the availability of contractors and things like that. I think speaking to a developer last week, he normally got about 25 applications whenever he went out for contractors. He's saying he's getting about 5 or 6 at the moment. So you can see that, you know, his feeling was that is an effect of Brexit already, and obviously the difficult climate in general we are in. So again, working with people on that side of things is really important. Final point, obviously, is funding lines. That's important for you guys to know. You know, we have 2 institutional funding lines, one of which is probably the biggest funding line in the specialist market. So we've got really good backing, but we've also got a varied degree of private lenders. 2 of our principals have their own funds as well. So I think we can cover everything from your pretty standard generics, you know, round up refurbishment schemes to the more quirky. And like most, you know, we will very much work in that grey area. You know, we're not a black and white lender. It's not a tick box exercise. We always understand that the vast majority there will be something that's a little bit quirky, but understanding that and using the positive mitigants against that to overcome it. So again, we'll look at products in a minute, but again, it's very much a guide. It's not a hard and fast rule. You know, I'd always say give the guys a call and we can always have a discussion about that. Moving on to just some key facts from a company. I won't cover everything off. I think there's just a few key points in there to take away. Firstly, I think is our formal terms to completion at 92%, you know, well above where the market is at the moment. I think a real testament to the level of work that the analysts, the underwriters do at an initial stage. We're not what I would call a fact packet lender in terms of you send us some figures, we'll put them back on a fancy term sheet and send it. They're doing a lot of work right up front, even at indicative stage, in understanding the location, liquidity in the market, exposure per unit, all these sorts of things. So actually you can know with confidence, once that formal offer's gone out, you know that it's, you know, bar any amazing things that come out of the woodwork, you will go through. And obviously with ourselves compared to more term loans and things like that, a formal offer with us is issued before we've had a valuation done, before potentially a monetary survey has gone out, before the legal work's been done. So actually you can see we've already done a really good analysis of that deal, be able to follow through 92% of those without any of those reports being in. The second point on there as well is our average completion time. You know, that is over a range of standard bridging right the way through to your more unique part complete developments, where you have to do due diligence on not only what they've done to date, but also what they're planning to do. So I think 4 weeks across, you know, a multitude of complex sites as well as the bridging is a quick turnaround time. And as I say, I think that's really important for us as a lender. You know, last year we reduced our minimum loan amount. And actually, we got to the point probably November last year where actually we felt that business had really ramped up again. And actually, if we continued at 250, service standards would have been hit. So for us, whereas other lenders, it's business levels and everything is around that. For us, service standards and turnaround times is the key. And whatever we have to do to maintain that, as I say, we ended up increasing the minimum loan slightly so that we could still maintain those service standards. And I think that's really important. The final point, I think, is looking across the board. You know, we are not a lender who just has one product that we focus on. You can see the varying degrees across both the bridging, the refurbishment, the ground up and the finish and exit, albeit the finish and exit volume is lower just because it's a smaller market. Part complete developments, there's not going to be £200 billion worth of business out there for it. But I think when you look at the values across the board, you know, I think that shows that we're equally strong on all our products, not just focusing on one. Obviously, I'm moving on to the important slide, obviously the one you may have seen already, but our 4 key products, albeit one broken down into 3. Starting with the finish and exit, as I say, that really is our USP. That's our flagship product. That is what allows us to step into part complete projects, refinance the current lender, finish the build cost, and also give them time at the end of the project to refinance, to sell. So this effectively will save your client 2 applications rather than going and finding more development finance, finding a dev exit, and then getting it onto a term loan or getting them sold. You do it all in one. There's no double bubble on fees, and actually when you look at the rate and where we can be in terms of leverage, it's competitive. And as I say, honestly, any clients you speak to who are struggling with developments, this really is a lifeline for them. I have an example later on that we can cover off, but the client was in real difficulty, at the point where he was funding it himself just to keep it going. He was selling some of his assets and things like that. We incorporated all his fees for him into the loan so that actually he didn't have to reduce his cash flow anymore, funded it, got him out, and actually he's now in a point where he's finished the project and looking to sell. So a really unique offering. As I say, I think a few lenders may have tried it, but as far as I'm aware right now, we really are the only person willing to step in. And I think it's a huge market because 9 times out of 10, there's nothing wrong with the scheme. It's just, last year was a prime example of that actually most of the issues were at the lender's end, not the client or the project. So I think that's really important to note. And as I say, loan range across the board for us, minimum loan is 400. Up to comfortably 5 million, I would say. If I'm honest with you, we probably are up to about 7 or 8 now across the products, but again, comfortably at 5 million. And again, you can see there the fees and everything. I won't go into huge amounts of detail in time, but as I say, I think that's the real USP of that product. Moving on to the refurbishment as a whole, so that's refurbishment and conversion. It's really straightforward with us and easy in how it's split, and you can quote with confidence off the back of this. These are the products, light, medium or heavy. It's really simple what it fits into. It's solely the build cost versus the current value. If you're sub 25%, you'll be light refurbishment, medium 25 to 50, above 50, you would be heavy refurbishment. So you speak to the client, goes, I'm buying for X, build costs are Y, right straight away, it's going to be a light refurbishment, a medium refurbishment, and then it's quick, you're quoting with confidence straight away. But also where we're really strong on this is rates that we're coming out with at the moment, extremely competitive in the refurb and conversion market. But also what you're getting with that is a really strong day one figure. You can see day one, we can do 70%. That's 70% net plus fees as well. So actually you're looking at probably 68% net, but also for the lighter stuff as well, 70% gross loan to GDV. So I think across the board, their leverage and rates, we're really competitive at the moment. And as I say, a simple product for you to be able to use. The only time you would probably move into heavy would be if there's a significant square footage increase above 25% of the current floor, you would probably be classed as heavy refurbishment. But otherwise, as I say, it's really straightforward. And I think, as I say, we're seeing a lot of business on this because of the leverage at the moment. I'm sure most of you get asked the question on all types of cases. You ask how much you want, and the answer tends to be max. That's what we're seeing. That's what I've tended to see historically. So again, we're really strong from that point of view as well. Moving on to residential bridging. Again, it's one product for all types of bridging. So whether that's auction purchases, development exits, BMV purchases, below market value transactions. We saw a lot of those last year, and I think we will see a lot again this year. And it's the same rate for all. So again, the BMV purchases is a really good one. We can do 80% of purchase price because that will normally fall within 70% of current market value. And again, you won't get a higher rate for that. You will still get 8% per annum. And I think that's important to note. Where that product sits quite well is the clients who actually have the cash, but they want to spread that over multiple sites. But also because they're inexperienced, they've got the cash, they tend to want a good rate with it. Now, there may be some out there who can do 90, 95 a purchase, but you'll probably pay for it. So ours sits quite well in getting a bit more on the leverage, but also keeping a strong rate on there as well. But also the bridging can work in with the finish and exit product. So with the finish and exit, we can step in as early as wind and water type stage. But actually, if we step in at a very late stage, you've got less than 10% of the build cost to be done. We would just do it on a bridge. We would refinance the current lender and the build cost all on day one, and it would obviously become a bridge rate of 8% rather than the finish and exit at 9%. So again, there's real flexibility across those products. Final one being obviously ground up development. The real niche with this is the minimum loan size. A lot of ground up development lenders will be looking $1 million plus as minimum loan, so we can very much look at those smaller deals, albeit a little bit more capped at the upper end of 2 million at the moment. That's not a choice. That is very much something we stepped in last year to do ground up a lot more, as a lot of people probably saw a lot of development lenders pulling out of the market. We had the infrastructure, we had the understanding, and actually sort of stepped into it. we are working with funding lines as we speak to try and increase that upper limit in line with the rest of our products, sort of 5 to 7 million. So again, watch this space. But as I say, I think the smaller product is really where the USP for that product is, and also the rate. 8% across the board is strong. But where this product can work well is we're flexible on experience, on location. So again, we can price accordingly. It's not a case of you have to have your own experience. It has to be a prime location. If you've got someone who's maybe, what we see quite a lot of is someone who's done a few refurbishments but not done a ground up development. They are also going to bring on a really experienced contractor. That's absolutely fine with us. We can look at those sort of things and price accordingly. And if you had someone who had no ground up experience whatsoever, good contractor, worst case, you'd probably be at 9%. So, that range is very close. And as I say, I think we price very well on the ground up across the board at the moment as well. So that really is the 4 key products for ourselves. Just touching on again, obviously you've got your fees across the bottom there as well, a standard 2% arrangement fee for all of us. Proc fees vary dependent on the product itself. But again, this is a guide. This is not a hard and fast rule. We can be flexible with all products. You come to me and say, look, I need to do something on the arrangement fee to win the deal. Let us know what it needs to be. And we'll work with you to build a bespoke product that works for your client, it works for you. And as I say, I think that's really important to know that we have this bespoke option. So again, these are guides, but if you ever need something to be done, give the guys a call. We can have a chat, and I'm sure we can try and sort something out for you as well. Final slides are just a few examples of some cases that we've done recently. This is actually a deal we're doing multiple sites for this client. They were with a smaller sort of private lender. That lender has now decided to retire and has called in all their funds basically. So we are looking at a range of deals for this client, but effectively got this deal done along with another one. I think this one was completed a standard bridge, but completed within 2 weeks. And again, I think that's important to know when the client was in a bit of a sticky situation, needing to repay lender pretty quickly, and across multiple sites. This was just one of several sites we're doing for them. The fact that we could get it turned around quickly, get him out before any default interest was starting to be charged, I think that's important to know on the bridge, that we can turn things around quickly, especially with how strong auctions tend to be at the moment. There's a lot of interest in the auction market at the moment. Looking at the next example, again, a ground up development, gives you an idea of where we priced on this deal as well. I think, strong loan to GDV, just shy of 65%, priced at 8% a year as well. So again, it's showing you that we're not dangling the carrots with these rates. These really are what we offer. And as I say, I think that's important to note. But again, a pretty standard demolition and ground up within London. So again, this is something that really is standard for us now. We see a lot of ground up. I think probably this year alone, January, 70-75% of our inquiries have been ground up. So there is a lot of development inquiries out there at the moment. But that's a mixture of people waiting back in the last year so that they could get going early Jan. People in generally are looking at the figures a lot earlier because of the uncertainty, more from a client's perspective than it probably is from a lender broker perspective. But yeah, I think the ground up market is going to be a very strong one this year as well. The next one, again, on a refurbishment, PD conversions is probably without a doubt what we see the most of on the refurb conversion products. And again, we do a lot of this. This can, again, show you the size of loans that we can do. This was something that we've done back early last year. But again, a conversion of 50 units. And again, the tight time frame, I think, is important. That's really where a USP from our service point of view is. The last one is probably the most important one because, again, I think the finish and exit product is a very unique one. And sometimes people think it may just be a fancy name for a dev exit or something like that. But effectively, this is the example that I showed you. Client was with a lender. That lender had said, look, we're in a position we cannot fund anymore. Came to us, we refinanced them. I think we started looking at the deal in late July. He had completed before the end of August. Refinanced the current lender, again, built all his fees, his monitoring surveyors fees, valuation fees into the loan, so he didn't have any issues with cash flow. Got it out, and actually, as I said, I think a couple of weeks ago, he's just finished the site and looking to move on. So a really, really important product, I think, to offer your clients as well. So that is everything from me. I don't know whether anyone had any questions at all. Oh, I think we've got a question on the bottom.
Adam, I'll ask. I've got some questions here as well. Just basically, as you can see from the screen there, any documentation you need, you can go to our website. We now are trying to collate, which is a bit of a nightmare for all the lenders we deal with, but trying to collate all the lender documentation, be it application forms, decision in principle forms, details of what fees they charge, basically everything all in one place. So if you have anything at all, any documentation needs, lenders.specialisthub.co.uk/Avamore. Obviously, if you need to discuss a case, then telephone numbers there. My team are waiting for your responses. I'm just going to go on to there's your question page. So, yeah, Roger Marlowe's asked you, Adam, would you consider financing the build of additional holiday lodges on an existing holiday lodge park?
We would probably struggle with that. Quite often with holiday lodge parks, you have restrictions on sales and things like that as well. I think that sort of market, commercial as a whole and these types of things as well, is something we have struggled with a bit last year. Because the commercial market, I think a lot of you have probably seen, has been more affected than the resi market. The resi market, if anything, got stronger last year. So we are very much focusing on residential stock as standard. HMO inquiries and things like that we can consider, but certainly a holiday lodge on an existing park, I think we would struggle with, unfortunately.
Okay. Next question I got is, what is Avamore's stance on clients' experience on developments?
Yep, so sort of briefly touched on it. I think we have really a varying degree. As I say, it's about how we price it rather than can or can't do it. And I think that's important to know. You've got really strong experience and really strong contractor. Yes, we will do it. You will be at probably 8%. If you've got someone who's lacking experience but's got a contractor on board, even if we did one last week actually, where a client has done only a couple of very light refurbishments, but it's got a really good contractor on board. Again, we're happy with it. We priced that at 9% rather than 8%. So again, it's very much about pricing rather than can we do it, can't we do it, to be honest with you. So again, that is very much an area we're seeing a lot of at the moment. A lot of people looking to get into the development market. So again, that's something we can definitely help with.
Okay, final question I've got, but someone else is typing something, is can someone use the finish and exit product to purchase a part complete scheme?
Yes, absolutely. We saw a lot of that back end last year. Historically, the product is the client coming back to you who's got into difficulty for one reason or another. But I think there's a lot of experienced guys out there at the moment that are finding these sites that maybe have someone stepped into it, first development project, the last year happened and have got themselves into difficulty. So there's a lot of experienced developers out there looking for these sites. They'll get them for a good price. They'll get them for cost to clear the current owners' funds. So again, definitely can help from that point of view as well.
Okay, and Phil's asked this is the final question. Phil's asked, will Avamore fund a purchase with possessory title? Client does not have perfect credit.
Absolutely. Look, the purchase with possessory title, it should be absolutely fine. And touching on the credit's a good point, because again, we don't really have a credit policy in terms of no defaults in the last 5 years, things like that. At the end of the day, our risk is the security. As long as that adverse credit has no potential risk on our property. For example, if you have someone who's potentially going through issues through the limited company that owns the property, and there could be recourse to repossess that property, then yes, that may be an issue. But in terms of personal issues, missed payments, defaults, things like that, again, 9 times out of 10, you've got a rational response why that has happened. Again, credit in general, we're pretty easy with, to be honest with you.
Okay, well, there is one more question just come up, so we'll take this as the final one. Client wants to build a flat in the same property as residential. Would you be able to consider? It says, would you be able to consider?
I think the key thing is absolutely right. We are an unregulated lender only. Where you have to be more careful with these, quite often someone will say, look, stick it in a limited company, it becomes unregulated. Where you've got to be careful is your MCD directive, and that's where you can get caught up. I think it's about what we charge. If it's a flat in the same block and we're taking the new flat as just a leasehold, then absolutely fine. Just about getting comfortable that they're not going to live in it. And quite often, that's a soft fact point. That's understanding the scenario. You have someone who lives in a property worth £1 million and they're building a block of flats worth 250 each. You can actually understand it. So again, it's very much something that we would look into. But as long as we can get comfortable, they're not going to live in it. Move from one to the other, then we should be absolutely fine.
Adam, that's brilliant. Thank you very much indeed. We're pretty much almost bang on time, so well done on that. Lovely to see you again.
Yeah, Andy, appreciate the time, Tony. Cheers.
To get your haircut, to be honest with you. But, yeah,
we'll start offering it with every loan, a free haircut.
Yeah, you're only welcome again if you're actually growing your hair from now on. So anyway, Adam, thank you very much. Be in touch soon, no doubt.
Thanks,
so okay, we'll move on to the next one. What I have to do, everyone, is between each one is a 5-second gap, because what we then do is to edit these down. And we'll then place these on our website. So if you've missed part of it or want to watch it again, or want to say it like one of your colleagues a particular presentation, then you can go on our website and kind of the whole thing. So just purely for editing purposes, there will be a 5-second gap. So bear with me 1 second. Okay, on to our second speaker now, who I've just been advised there's a problem with his internet, in that he'll actually appear and we can hear and see him, but he's about 5 seconds behind. So if I do ask him a question or talk to him, he's not ignoring me, or it's just the fact that there's an issue with his internet. He's just coming on now. So I did this last night and put his picture up, and I'm desperate to know whether that is his house that he's drinking that glass of wine at, because if it is, he's got a very, very big house. Or if that's a recent photograph in a hotel, how the hell did he get a photograph in a hotel with a glass of wine? So, Gary, are you
there? I am here, thank you, Tony. I can hear you loud and clear.
Right.
That just very quickly, that was when I drove to see a broker in Devon. So I got to the hotel, quickly got out of my gear, went and got a glass of wine at the hotel. Asked the girl, said, "What size of wine do you want?" "Large, please, give it to me." But an hour later, he comes back and said, "Do you want another glass?" I said, "Yeah, absolutely fine, thank you." And I said, "Just as a matter of interest, how much was that?" She said, "That's £14. At that point, I left the wine and decided to go and drink somewhere else.
I would have stolen the glass, to be honest with you. 14 quid. Right, okay. Well, I'll just do Gary's introduction first of all. So I've actually got this slide correct. He's our second speaker. So you should have received this morning via email. So hopefully you won't print it because you use up all your toner ink. But that's their criteria guide for their home flexi loan. I'm just actually, before I go on to Gary, I've been in second charges now since 1983. I can count probably on the fingers of one hand the times that a lender has come out with something that has been completely unique to the marketplace. And Selina Finance's proposition is one of those times. This came out in November. We're very lucky to be brought on board right at the start. And this really is a game changer when it comes to second charges. So pay attention to this one. This is hopefully going to be good. The fact he's got his Everton stuff behind him, maybe not so good. But anyway, so just a little bit about Gary, first of all. He's a business development manager at Selina Finance, providing nationwide coverage to their key partners. He's been working in the specialist lending industry since 2004, working for both a lender and a packager key partner. For the past 6 years, he specialised in the second charge market, and prior to that in the commercial mortgage sector. He has 2 children, and his family have recently acquired an Irish setter puppy who thinks Gary is his personal play toy, as the holes in his hands will testify. As you will shortly hear, well, you've already heard, obviously, Gary is a Scouser. Would never have guessed Gary. Although no longer lives in the city, he's an avid Everton fan. There you go. And his claim to fame, his interesting fact, he once appeared alongside, and it says his brother. When he sent this over, it said Gary once appeared alongside my brother. And I'm pretty sure my brother's going to be in Brookside. So Gary once appeared alongside his brother as an extra in Liverpool's long-running soap Brookside. No words, just a walk-on role, or to be more accurate, coming out of a police car to arrest a suspect in a nightclub. Was you nominated for an Oscar for that, by the way, Gary, or was there any awards?
Waiting for a BAFTA, Grammy.
Okay. He used to play for Brookside's football team in charity matches alongside the actors Paul Usher and Simon O'Brien, amongst others, and has played at prestigious grounds such as Crewe FC and St Helens Rugby Ground. Never been to either. Couldn't tell you whether they're prestigious or not. So on to the presentation. Gary, it's all yours. Everyone listen to this one because this really is, for the second charge market, this is the best thing I've seen in well over 15 years.
Thank you, Tony. Good morning, everyone. I hope you're all well. and thank you very much for all your time today. What I will do is just briefly run through the introduction. So I'll tell you a little bit about myself, although Tony is told you more than you need to know. Brief history about Selina, about the product, and then about the flexi loan that we've brought to the market, which is, Tony's quite correct, it came to the market end of November, beginning of December, and the feedback we've had from our key partners has been extraordinary. One of our key partners quoted us as saying it's the most innovative product brought to the second charge market since MCD. On the back of that, the traction that we've been receiving from our key partners has been astonishing, and it's a testament to how good the product is. So I'll talk about the product and then give you some case scenarios, and then just reiterate what our USPs for the product. It's a product that I'm really, really excited about, and hopefully, if it continues to do what it's done in the first couple of months, we're just going to take the market by storm. I'll just quickly shoot through that slide, but that's a lovely picture of me with my wine, as you all know about. But the last 6 years of my career, I've worked predominantly for Shawbrook Bank as a business development manager in the second charge product, and 2 years as a master broker. So I've been at the front end as well, and that was with Smart Money. And then I joined Selina to launch this product in October 2020. So in respect to Selina Finance, probably a lot of you guys would not have known about those, or certainly heard of the company. The company was founded in the summer of 2019, and it was to lend in the unregulated market for businesses and portfolio landlords. So we have on our regulated side a business and a portfolio landlord proposition. We submitted our application for FCA lender permissions in end of 2019. And while that was all being processed, we were building our technology platform. So we are a fintech lender. So if your clients are actually doing a second charge, pretty much the only thing they will actually need a wet signature on will be the mortgage deed for the land registry. There will be no application form. Everything is done online. And then at the end of Q4 2020, we got our lender permissions and we launched into the market. We have a limited distribution panel, and it's fantastic that Tony and the team from the Specialist Financial Hub are on board, and they've provided great traction for us, and also preaching about our product. So I'll talk about our product and I'll go left to right. So just some of the criteria and what we're actually looking for, which is important for you guys to know, and then literally give you some case scenarios. So our minimum loan is 25,000. It is all on a second charge residential product, up to a maximum of £1 million. With our employed clients, we just need your clients to have 3 months employed. As long as there's no probation and they've been working for 3 months, we're actually good. They could be from one industry to another industry. They don't have to be in a continuous industry. And with self-employed, we're just looking for 12 months. So we'll put our COVID criteria in at the moment, which would be, if you are self-employed, you've been trading for at least 12 months, rather than asking for SA 302s or accounts, we are just going to ask for an accountant certificate. That's all we will need from the accountant to confirm what you're trading as. But what we will need bank statements just to confirm that you've been trading through COVID. But we're probably one of the most flexible lenders on that basis there. Our interest rate starts at 4.45%. And more importantly, we will lend up to 75% loan to value. Affordability, we will work off loan to income, which is 6 times on all cases. And we also have a debt to income, which is 45% of secured debt against the gross income. I think we're quite different in the marketplace as well. We do work off credit score, but we work off Experian, which I know most of the first charge brokers will work off. What we're really good is we have just a minimum score of 800. If your client passes that minimum score of 800, they will qualify for our best rate of 4.45%. So what we don't do is discriminate. So if our minimum score is 800 and we'll give you a rate of 6.45, no, we'll give you our best rate of 4.45. And our maximum term is 30 years. We will go from 5 years to 30 years. Age is 25 to 75 at the end of the product. Probably the most important bit is this bit here, the 5 years, the flexible loan period. So the flexible loan is a credit line which allows your clients to draw funds flexibly over the first 5 years and only pay interest on the outstanding balance. So pretty much what you will be getting is a secured loan, which you can do for 30 years, but it's like an overdraft facility for the first 5 years. So in essence, it's a revolving credit facility. So I will show you some slides, but if you've got a client who's borrowing £100,000, we work affordability on the term that your clients do the secured loan over, whether that's 10 years, 15 years, 25 or 30 years. But what they will have is they have the facility during the first 5 years to draw what they need of that £100,000. So if, for instance, from day one, they only need to draw down £25,000, they can draw down £25,000, and they will only get charged interest on that £25,000. So they will not get charged interest on the whole of the loan. They only get charged interest of what they use as and when they use it. So I've got a couple of slides which will perfectly demonstrate that for you. But with the facility, it's all about flexibility. So our minimum drawdown once they've taken out the loan is £5,000. They can do drawdowns in £1,000, but what they can also do is pay back at any time without no ERCs on there. Pardon me. And there's no charge for moving up and down within the facility. So the flexibility is key for us. And also, which is a really big selling point, there's no non-utilization fee. So if the clients come to the end of 5 years and they had a facility for 100,000 and they've only drawn £60,000, they only get charged for the interest of 60,000 and there's no non-utilization fee. So we will have, to make life simplistically as possible, we have a fixed and a variable rate. So we can have a variable rate starting at 4.45% or a fixed rate starting at 4.95%. And the fixed rate that we'll have will be over 5 years. Why we're also different in the marketplace, all our valuations we are trying to do on home track. Now, I know other lenders will do home track, but we will have no restrictions on loan size. So our loan size is up to 75%. Well, sorry, no restrictions on loan amount. So you could do £1 million loan for up to 75%, and we can take that as an AVM. So the advantage for your clients is it's going to save them considerable amounts on valuation fees and also speed. A home track can be done, click a few buttons and it's there in 30 seconds, which Tony and the team can do. So at the moment, we've got a deal going through whereby it's just over £100,000 as a loan, but it's valued up at 1.8 million on the home track, and we need nothing else on the back end of that. We're happy to do that. Now, if it doesn't pass home track, that's not the end of the story. We can do a RICS valuation, but again, we're trying to be flexible to help our key partners out there, and we don't per se have a panel valuers. So we don't necessarily have to use pure Metropolis, for instance, or Gateway. If you have got a client and he's in a rural area and there's a specific valuer who's close by, who's got RICS behind the name, we are happy to take that. No problems at all. There's no early repayment charges on any of our loans, whether it's fixed or variable, and your client can repay the facility at any time. So we asked the question by a broker yesterday, if the client wants to make an overpayment every single month of £200 or £250, what will we actually do? Quite simply, we will change their direct debit every single month to reflect the reducing balance on that case. So even if the direct debit was only changed by £5 or £10, we would actually do that. So we have the two rates, the fixed or variable rate, and we give the different options. We can have a fixed rate of 4.45 with a 995 fee added on, or they can have a variable rate slightly higher by 0.5%, but with a 0 fee. So that's optional. So the product is a second charge on a residential property. However, we can do third charges as well. And again, we're different probably than any other lender in the marketplace with third charges. As long as it fits our up to 75% LTV, and as long as it fits affordability, if we have a third charge and it qualifies for the rate of 4.45%, we will give them the rate of 4.45%. So there's no equitable charge and there's no actual loading on the rate at all. Obviously, we would just need consent for the first and the second charge lenders respectively. So in essence, this is how it would work for you, for your guys out there. So you've got someone in this case here who's looking to take a facility of £75,000, which is the available funds. And from year one, they've drawn down 40k. So on that 40k, that's all they will get interest charged on. Year 2, then they've increased that up to 49,000, and the monthly payment will go up on that basis there. Year 3, 53, 57, 60 till year 5. Once you've taken the loan out, which is really important, so our minimum loan is 25,000. So let's say a client comes to us and wants, let's say, just say 25,000. To open up that facility, they would only need to draw down 5,000 from day one, and that facility would be opened, and then they would have that facility then for up to that 5 years to use that 25,000 as and when they need it on that basis there. The other thing with the flexibility, when they are drawn initial drawdowns of the funds, they can actually draw down as little as £1,000 each and every drawdown, and there is no charge for making as many drawdowns as they want during that time. So on this example here, we've got the loan after 5 years. They've only used £60,000, so they've not used the full 75,000. That £60,000 then becomes crystallised and repays it over the remaining term. So in this case, it was a 25-year term. The advantage is what they've not used, there's no non-utilisation fee at all there. Okay, so where we're getting our business from now and the traction that we're getting from our key partners. So we're doing a lot on home improvements or home renovations. So we're tending to find that the deals that we're getting now are the deals from 40,000 and above. So we've got a couple of nice chunky £100,000 renovation deals where it's ideal for someone who's building a double-storey extension. So from day one, they're paying the builder for materials, which might be 30,000. Then in 6 months' time, as the builder needs additional funds, we'll release further monies, and remembering that they're only getting charged for what they're releasing at any time. And then we're also then you can build in contingency funds. So one of our brokers has done a deal with ourselves whereby it's one of the ones for £100,000. The clients have got quotations to do costings for the home renovation, which is just over £85,000. And what he's done, he spoke to the clients and he's built in a contingency fund. So what he was saying to ourselves, he does a lot of these huge home improvements, is that generally the clients get to use all the monies, use the £85,000 and then realise that suddenly they've run out of money. So what they'll actually do then is go and generally put money on credit cards, paying at a higher rate. Here, he's built in a contingency fund to take the loan to 100,000. It makes no detrimental interest rate with being charged. And if the clients don't actually use the contingency fund, then that's fine. We've just crystallised the loan after 5 years to the remaining term on that basis there. We've also got quite a few deals in with property investment. So when I say property investment, it would just be like myself, who has got an existing first charge property, lots of equity in there, and maybe I'm going to become a first-time landlord. So we're quite happy to borrow your clients. If they're in a situation like myself, 150,000 as a second charge for me to go to the auction, I can go and buy that property maybe for £100,000 and then use the other £50,000 to refurbish that property up. What the advantages of that is that once that's all done, if the clients want to sell that property, then that's fine. There's no ERCs. But the advantage for ourselves is once that facility is open, it remains open for 5 years. So if they did have 150,000, they've done a property, they've flipped it over and they want to pay 130,000 back, that's fine. So the facility's still got 20,000 or there's still a debt of 20,000. They can then go and borrow up to that 150,000 again at any time during those 5 years. So we've got a school fee. We're doing a deal at the moment for school fees, and there's a lovely slide on school fees, which probably emphasises, as well as the renovation slide I'm going to show you in a second, how the actual product works. And then we can use it for multi-purpose. So when I say multi-purpose, if someone wants to do a home improvement, some debt consolidation, pay a tax bill off, it doesn't matter. We can have multi-purposes within that one loan. So we're quite happy to do that. So we've got a slide here which probably emphasizes it more on a monthly payment of how the actual product works. So in this case, Mr. and Mrs. Smith asked for a loan of 60,000. The interest rate was 5% and the loan term was 30 years. In month 1, they draw 20k down, which is here, and that's £107 a month. They don't need any further monies until month 6. And then they've increased the drawdown to 26,000, which shows us increasing the monthly payment to £140. Again, in month 12, they come back and need further monies for 10k, which takes them up to 36, and the monthly payment goes up to £194. And finally, on month 18, they draw down another 15k, which takes the repayment to 276, and which would be 50k there. Now, if they never used any more money for the remaining 5 years, whatever the outstanding balance is then is transferred over to the term loan on that basis there. What we've found, because we've done this on our business purpose products, we think that most people who will use the facility, especially for home renovations, will probably have the full drawdown with 18 months. What we think we're buy-to-let or investors who are going to use to purchase a buy-to-let on their own property, then they will probably use the facility more as a flexible facility where they can draw down, use the facility, pay some back, draw back up against it during that period of time. And this slide we specifically did for one of our key partners because he emphasized how good it is for school fee planning. So he deals with a lot of high net worth clients. And he had a case last year where he needed £200,000 to pay for 2 children to pay for their school fees for private school for the next 5 years. The case was signed off by one of our competitors, and he said they were absolutely brilliant, great rates, no problems at all. He said the issue is, on his case, they needed £200,000. They had the rate, but in year 1, they only needed £40,000. So they took the £40,000 out, paid the school, which was great, but they were sat there with 160,000 in their current account or a savings account, earning no interest and getting charged interest for having that facility on that basis there. So with this facility, year 1, if they only needed 15,000 for the 2 children or 1 child's terms, 15k gets in, the 65,000 remains there, and they're not getting charged interest on it. So it's only £81 a month. Year 2, they draw another 15k, payment goes to 162. Year 3, 44k in this, or 15k to 245, and in year 4 and 5 they draw down until a flexible facility is used on that basis there. So just to recap some of our USPs, and if there's any questions, I can run through them. We will do our home track for up to 75%, and there's no restriction on loan size, completely unique into the marketplace. We're new to the market, so we have fast turnaround times, obviously, because we are new, but we've also got direct access to any of our underwriters as well. So we've got a team of underwriters there who you can have direct access to. They will pick up the phone and they will speak to you directly. And also, it gives you an opportunity to expand your market. So we have brokers who've been on to us and turned around saying they are now getting interest from first charge brokers who have either never done a second charge before, who would never do a second charge because of either rates or because of lack of flexibility within the product. They are now getting brokers who are asking for more details on the product. For the customer, the advantages or the USPs are the flexible loan is a highly flexible credit facility. You only pay for what you draw down. You can go up and go down within the facility, and there's no non-utilization fee. And most of them, all very importantly, there's no ERCs within that product at all. And that is me. So thank you very much for listening.
Gary, thank
Tony.
you very much indeed. I did say it was unique, this product, didn't I? And Gary's coming right at the start that this is the best product to come out since what did you say? Since MCOB or since basically
MCD?
NCD.
Yeah, I say MCD. Yeah.
Since MCD. Well, I honestly can't remember a game-changing product like this since I received a phone call in 1997 from a guy who was a BDM for First Plus Finance saying we'll now lend to 125% loan to value, which obviously opened up a complete a new market to everybody all brokers out there. This is, to me, as much of a game changer as that one was. And I can see other lenders are going to follow suit on this. And I have actually, and don't want to blow me on trumpet here, I did suggest this to a number of lenders years ago that they should be looking at a product like this because it makes so much sense. If you've got your buy-to-let investors that want access to quick funds, well, if they've already got a facility in place and they then want to buy something at auction, for example, then they've got their deposit. They've got the money they need, or if they want to buy just a normal buy-to-let, they've got the money they need. If they want to do a purchase and refurb and then sell, for them, for that 5 years, it's a fantastic product. Someone doing a home extension, absolutely fabulous product. Who wants to borrow 150 grand all up front when you can borrow it in stages for an extension that's going to take you probably about a year, 15 months? So to me, wonderful product. I'm absolutely delighted that we're on board. I do know that our first deal that we're hoping to complete will hopefully be one of your largest as well, because the guy does need a lot of money. So, and he's got an absolute shed load of equity in his property and earns a fortune. So anyway, we do have some questions, which is excellent. So I'll read these down. Darren Amos, good morning, Darren. Can you secure over more than one property?
No, we just go secure on the residential property, Tony.
Okay, that's what I was going to say. So I'll come to the next question in a moment because it's quite a lengthy one. Colin McNulty, that's actually just been answered. Do you only offer second charge on residential homes? It is just on residential property at the moment, not on buy-to-let. Although obviously we do have other lenders that will lend on buy-to-let properties as a second charge. Jim Hallam has said, regards, say, a 50 grand loan, what will be the typical setting up charges for the client? As far as the lender fee is concerned, just remind me, because I haven't got the terms in front of me. Is it 2%?
Yeah.
2%?
No. So we will have. They've got two options, Tony. They can have a zero. You can have a zero lender fee, so there'll be no charges in that case, or a £995 fee, which can be added to the loan. So they're the only two charges. There's no either charge for exiting the loan as well, so there's no other charges on the product at all.
Okay. And Jim, as far as any broker or packager fees are concerned, if you have the authorizations and you're able to give the advice yourself through us, you do have the option of actually, with which I'll be talking about later, where there wouldn't be any, we wouldn't charge any fees either. So your income will be derived from whatever fee you decide to charge. So if you just want to charge him 495 quid, then you can do, and that would be the only fee, potentially the only fee the client will be charged. And no ERCs as well. To me, this product is, it should be flying off the shelves fairly shortly, I reckon. So, okay, I'm now going to ask you a question by somebody called Richard Kroll, who happens to be an ex-employee of mine. And you might know him actually, Gary. So he's asked a question which I'm going to partly answer, and then I'll let you answer as well. So, hi, Gary. As you know, many second charges are for consolidation and credit repair. With the Flexi Loan facility, is there an option to reduce the credit limit or remove it if it's felt that the customer shouldn't have access to such a facility in light of the previous credit problems or over borrowing they had? It may well be that Selina is the best rate for the customer, but the facility isn't suitable for them.
Okay, do you want me to answer that, Tony? Yeah.
You answer it first. Okay. I'll then chip in with my bits. You answer it as a lender. I'll chip in as a broker packager.
Okay, so first of all, as a lender, once we've agreed the facility, we don't remove that facility at all. So the facility remains there for 5 years, whether it's 25,000, 50,000. Obviously, it's up to the client to decide whether they use the facility on that basis there. Also, our product, to be totally honest with you, is very much aimed at a prime audience. So if there's someone with numerous CCJs, for argument's sake, it's probably not a client for ourselves on that basis there. And also, probably last but not least, from my experience working for Shawbrook Bank and also working for a key distributor packager as well, if someone came to me and they were just looking to do £35,000 and it was all for debt consolidation, from my experience, then generally most lenders or most brokers will just look to do the £35,000 with the cheapest rate to repair the credit, and that's probably going to be remortgaged or refinanced away on that moment in time. So I don't foresee our product is going to appeal for a lot of people with debt consolidation. The only time I think it might happen is if we're doing a multi-purpose product, so we're doing debt consolidation and some home improvements in the background on that basis there.
And let's face it, if somebody needs, say, a facility of 200 grand because they want to consolidate some debt and also do an extension on their property, their option at the moment is to borrow it all up front. Yep. The option this gives is to borrow it over the time period that is actually where the payments are going to be needed. So as far as the question's concerned, and a lot of as far as my firm's concerned, I ensure my staff try to identify situations where if we have what we class as a vulnerable customer or somebody that is going to be using this for the wrong reasons, we'll find out about it and we won't do it. I mean, the amount of times we've now declined cases because we know the clients have got a problem, be it gambling, is probably the biggest one we see, and we will not do the case. we just refuse to do it on the basis that it's not in the best interest of the customer. I'd rather do that than do a case, earn £1,000 out of it, and it then comes back to bite me on the bum in 3 years' time when the client gets hold of a claims management company and says I was vulnerable. So there's a certain onus on the whoever's giving the advice, and that certainly is something that I would always ensure my staff do. But to me, the product at the moment, it just allows the client to borrow the money in their own time at their own speed, and not at the lender's speed. So to me, it's an absolute no-brainer. It's not going to be for debt consolidation. Just debt. If someone comes to us for debt consolidation, you're not the cheapest. At 75%, I've probably got 5-6 lenders that offer cheaper products, and also new ERCs in many cases as well. But for the market you're aiming at, school fees, the buy-to-let investor, the property improvements, this is an absolute godsend. I really can't stress it more than that. And I know exactly how we're going to market this. I'm not going to say how we're going to market, but how we're going to market this to bring in as much business as possible, because this is a real game changer. So we've no more questions from, there is someone typing. Richard Kroll, and hello Richard, how are you, by the way? I didn't actually say that. So he's an ex-employee of mine. It's a great product and great to see, I agree. Questions, we had some pre-done questions just in case we didn't get any questions. I'll just ask a couple. What is your COVID policy for self-employed?
Very straightforward, Tony. We would need an accountant certificate rather than 2 years SA 302s for argument's sake. So as long as they've had at least 12 months trading, we will take an accountant certificate. What we will need to back that up, though, is 6 months business bank statements so we can see how the company's been trading through the COVID times. Okay.
And is there a minimum balance that the clients need to leave after 18 months to keep the facility open?
Straight answer is no.
Okay.
They can reduce it down to zero, but still have the facility there in the background for the remaining 36 months on that basis for the 5 years.
Okay, and Paula has just sneaked in a question right at the death. So thank you, Paula, and good morning. Will there be a time when you will offer it on buy-to-let property?
The straight answer to that is this is all for residential. We do have a buy-to-let arm, so we offer a similar product, not quite the same, but a similar product on our buy-to-let. But I know you'll have access to that as well as your other lenders out there, Tony.
Okay, so if you have any clients that you feel this would be of benefit to, and either you want somebody else to give the advice or you'll have to give the advice yourselves, give us a call. Don't call Gary because on the number there. Give us a call because my staff are waiting for your calls and can start placing the business immediately. So that's what it's there. That's why we're here today. So, Gary, thank you very, very much indeed. Lovely to see you again.
Thank you, Tony, and thanks for all your time.
Absolutely delighted that West Ham are above Everton in the league at the moment, but I'm sure it won't last very long. So what we're going to do now, everybody, is we'll take 20 past 11. We'll take a break until 11:30, and then come back and with our third speaker. I will see you then. Welcome back, everyone. As you can see from this slide that's just appeared, two things you'll see. This is our next speaker, which is Kitt Makwana, who is with us, but I'm just waiting for him to come on board. As you can also see, obviously, I can no longer count because it's not our second speaker, it's our third speaker. So must do better next time, I think, is what I'm going to take away from today as far as getting these slides set up and not leaving it to the last minute. So I just want to ensure Kitt's going to appear. There he is, right, he's there. Good. Okay, so as always, first thing you need to do is you would have received this by email this morning, which is their interim criteria guide and some new rates that came out. I think it was just before Christmas. On the West One buy-to-let side of things, we were very fortunate to be. I mean, we've dealt with on the bridging side and also the second charge side for quite some time. We were delighted to be brought on board by them during lockdown 1, I believe it was. Last year as one of onto their sort of premier packaging panel. So we're now with them. Kitt has just appeared. So Kitt, can you hear me? Can we hear you?
I can hear you fine, Tony. How are you?
I'm very well. How are you?
I'm very well, thank you.
Marvelous.
Thank you for the opportunity today.
Kitt and I have never actually met person to person. We've spoken, but when I saw his face yesterday when they sent over the photograph, I realised I probably sat next to him at about a dozen industry events over the years. So yeah, we have met on many occasions. Just obviously just didn't register with my old brain, basically. Okay, so a little bit first of all on a little bit about Kitt. First of all, 17 years of financial service experience across retail and private banking, wealth management, and specialist lending. Has worked across all areas of property-related lending, from residential mortgages through to buy-to-let, second charges, bridging, and commercial. Prior to West One, Kitt worked at both Together and Barclays. He's worked in the intermediary market for over 5 years and enjoys supporting brokers with their tricky cases. And Kitt is a big Tottenham Hotspur fan, coming from a family that is all Tottenham Hotspur, and I was like the black sheep who decided all the way back in 1968 that I would support West Ham because Bobby Moore played for them and I like their colours.
Yeah.
My opinion of Tottenham supporters, seeing as they normally do better on West Ham, is not that great. So hopefully you're going to redeem yourself today, Kitt. Just a little bit on Kitt's. Now, this obviously is a very brief, interesting fact that he once had lunch on a US Navy warship in Indonesia. What I normally try and do is if somebody doesn't come up with, their interesting fact isn't that detailed, I then stalk them on Facebook and LinkedIn to see what else I can find out about them. Luckily, Kitt, you seem to have actually cleaned yours up a bit, because other than a couple of dodgy photographs on Facebook that I found last night, there was nothing that I could really embarrass you with. So just a little bit of lunch on a US Navy warship in Indonesia. Would you...
Thank you, Tony. That was just in my traveling days when me and two friends ended up in Bali through no planning. We ended up in Bali, and as we were there, the US Navy arrived and stayed in our hotel and hostel, and we got friendly with some of the guys, and they were kind enough to actually invite us aboard. We had lunch, we had a tour of the ship. Interestingly, every single US warship has a 400-meter running track installed in them, so for fitness. And every single warship also has an indoor putting green as well, by the way. So it was an interesting kind of experience, because although we weren't allowed in any major secret areas, which you'd understand, the vastness of the vessels was amazing. So, and they could not have been any more hospitable as well. So, a fantastic experience. So,
I just wanted to make sure you wasn't acting as a pirate at the time or anything like that.
No, I wasn't. Maybe I should have been a bit more clearer on my interesting facts, in fairness, Tony, in hindsight. Thank you for that. Yes.
Or a stowaway, of course, or something like that.
Yeah, exactly.
Anyway, right, okay, so Kitt, it's over to you. I will just disappear in a second and over to you. So your first slide is just about to appear, hopefully.
Oh, fantastic.
Okay.
Yeah,
see you in 20
brilliant. Excellent. Well, thank you so much for that kind introduction, Tony. And good morning, everyone. Thank you so much for taking the time to join this web show today. And firstly, a big thank you to Tony and Kylie for arranging and inviting West One. So as he gave us such a great introduction, my name is Kitt. I'm a key account manager from the buy-to-let team in West One. And I realise, obviously, this is not the ideal way for me to talk about our proposition, but in the modern world, we are where we are, and we make the most of it. And I thank Specialist Hub for doing that for us today. So my time is limited. So there's 4 key areas that I'm going to be covering in our meeting today. It's very much about how we can help our clients. The clients that we do actually help, the portfolio, the profile of the clients, the property types that we can consider, and also what you can refer into us and talk to us about before application. So we're a very manual lender, and I'll cover that in just one moment for you. So some of the things that we do, and forgive the vast amount of information on this slide. Kylie and I had some tech issues about getting this correctly for you guys. Firstly, everything that we do is manually underwritten. So although we are a specialist lender, we're growing the arm of the buy-to-let branch of West One, we are still a manual operation. So you can talk to underwriters directly. You can talk to us about cases before you submit them. We want to know that when your case comes in, that there's a very good chance it's going to go through to completion without hitting the sides. So we encourage you to talk to us. And some of the key things there about how we can help are quite clear. So Our loan to value, we now go up to 80% on certain products up to £250,000. And our ICR there at 125, 135 and 140, fairly standard in the industry, I think you'll agree. However, the difference is all of our ICRs are always based on interest only. So if your clients are ever going to be doing a repayment-based mortgage with West One, we'll allow that, but the ICR would always be based on interest only. Another factor to consider on top of the ICR is the fact that we do not have a minimum income requirement from clients. We ask them to have a income, but we do not have a minimum income of 20, 25,000. That's absolutely fine. And a little bit on the adverse side of our business for you guys to be mindful of. We are not a heavy adverse lender, as some of the points there indicate. Someone's just asked me, ICR 125% at what rate? That's on 2-year products, it's stressed at 5%, and on 5-year products, it's stressed at pay rate. So thank you for that. Great question. That's from Darren. Thank you, Darren. And with the adverse as well, as you can see, with defaults and CCJs, anything that's up to £350 is ignored on our W2 plan, and I'll talk about our plans later. So anything up to £350 is ignored. Even if it's within the last 3 years, we do not mind. And historic mortgage arrears as well, anything that's over 2 years old, we also ignore. So we may ask for an explanation about why these arrears happened and why they, and you know what the client did about it. But in essence, we do ignore anything over 2 years. Thirdly, on there, unsecured lending. If your clients do have any unsecured loans, anything, the maximum that we'll accept in the last 12 months will be a status 1 on these accounts. That's the max that we go for. And payday loans. With payday loans, we have an interesting stance because even now in the market as we stand, there are still clients that you guys will come across which will have payday loans. For example, you know, they've taken them out when they were, you know, silly adverts on TV. With us, any payday loan that's over 12 months old is ignored. And I'll talk about payday loans in just one moment as well. So, sorry, just bring up the next slide. Apologies. Okay, so the clients that we can help as well. So with us, we are able to help first-time landlords. Even if that first-time landlord is working on a HMO or multi-unit freehold block, we can help. The only thing that we ask landlords, first-time landlords, to have is a mortgage or rental history, or one applicant on a mortgage to have a mortgage or rental history. That's all. So if you are talking about your first-time landlord, someone who lives at home with mum and dad, for example, and they're doing their first ever buy-to-let, we will help that client provided they're on a mortgage with a family member or someone who has a mortgage or rental profile. Limited companies, LLPs and SPVs, we have no minimum trading time. So if that company is set up as a subsidiary of a trading business or as a brand new limited company, we'll be able to help them as soon as they're set up. The only thing that we ask with limited companies or any companies that we lend to, they must have property related SIC codes that we ask for. So that's quite key. With us as well, EEA nationals, as long as they've been resident in the UK for 3 years, we'll be able to help. And also expats. We've just dipped our toe back into the expat market, and we are looking to help expats who can actually, if they're based in the EEA, it's absolutely fine. If they're based worldwide, we're doing cases with people based in Australasia and the Far East. It's on referral to us. Please speak to our team about this. And then, you know, as long as you get the okay from our team, you're more than welcome to submit the application. Okay? That is on a limited distribution basis at the moment. So if you want more information on that, do they just let me know. Okay? And Darren has asked another question. do they need to have a current property in the UK? Yes, they do. So expats, we would ask them to have one buy-to-let property already in the UK. So if they're expat, their residential home is normally let anyway. So their ex-residential home, as long as it's let, that will be fine. Thank you, Darren, for that calculation. Okay. Also, with portfolio landlords, okay, we do not have a restriction on the number of properties that they hold with other lenders. And we do not need any additional verification checks like e-tech or EDM. So with us, with portfolio landlords, we do not stress test their portfolios in the background. We're going to ask for a summary of all of their properties, all of their mortgage balances, and the rent that's coming in. As long as these portfolios are self-sustaining, whereby the client's not inputting any of their own money into these portfolios, then we are comfortable to lend. So we are not that lender that's going to stress test the portfolio at, say, 140% at 5.5. We won't do that. And I know it's obvious, but I wanted to make this point very clear. We do get questions regarding why we would allow clients to remortgage. It says there, any reasonable legal, domestic, or family purpose. So if your client is remortgaging a buy-to-let and using extra money to take their family on holiday, well, holidays will be nice at some point, or if they're buying some, if they're investing money into their business, that's absolutely fine. Any legal, domestic, or family purpose. So we are quite generous in what we do. The next slide is the type of property that we can lend on. So sorry again for this information. I know it's quite a lot of lines that I'm not normally do on a PowerPoint, but I'll bring this to life for you as best as I can. So the property we can lend on, if it's a standard AST, we will go up to 6 bedrooms with an acreage of about 1 acre. That's what we like on a single AST. If their clients are looking at HMOs, we will be in the HMO market, and we are currently looking at 6 bedrooms. That's our kind of sweet spot with HMOs. It says on their license, but the license for a HMO can also be applied for as part of the mortgage application. So we're happy to do that. And multi-unit freehold blocks. Multi-unit freehold blocks, we will go up to 10 units, but we do insist that the minimum square meterage per unit is 30. That's our place to be. A new build flats, a new build property generally, we will go up to 65%. High-rise flats, up to 5 stories, we will do comfortably. The only thing that we insist on, and I know there's some media coverage on this, we still require the EWS1 form if that building has any type of cladding. So we want that clarified to make sure it's a safe building for tenants to live in and for us to lend to. Holiday lets, like the expat market, we just re-dipped our toe into this market. The difference with West One is that we will base any holiday let lending on the AST value. So as quality brokers, as I know you guys are, everyone knows that holiday let property will have a high, medium, and low season. We understand that, but we will need to know that that property, if there's further restrictions in the UK, or or if there's less demand in certain times of the year, we need to know that that property can be let on an AST basis if required. As I mentioned before, studio flats, same as the multi-unit freehold blocks, we do insist on the minimum square meterage of 30 square meters. And exposure for us, I will explain this because this is a difficult sentence to write on. So our maximum exposure is the higher 4 or 25% of that block. So let me explain. So, and I'll use Darren as an example. If Darren is a investor looking to invest into a property, if that block had, say, 6 flats in that property, we'll be looking to do 4 because that's higher of 4 or 25%. If, for example, Darren was looking to buy a block of, say, 20, for example, we'll be able to do 5 because 25% in that scenario is higher. And Robert Smith has just asked a question: can the planning lawful use be applied for HMOs? Yes, it can. So that lawful use and that license can be applied for as part of the application. Great question. Thank you, Robert. So and flying freeholds. I think it's fair to say that we're not inundated with flying freehold applications, but we can accept flying freehold up to 10%. And the last point on there was regarding the open market value figures of properties. So, as you guys all know, for any valuation, especially on the buy-to-let side, there's a 90-day value, there's a 180-day value, and there's an open market value as well. As a lender, we work on the open market value figure of a property. The only time that we'll normally look to vary that, if ever, would be if there was a new build property that had a new build premium. We need to strip out that premium to make sure that the LTV that we're lending to is correct for that property. Okay. And Paul Rhodes has just asked a question: is the open market value same as vacant possession? Yes, it is. Okay, and the things that we can consider by referral, and this is the last slide from me. So one thing that we're incredibly good at is, as I say, the property types that we would lend to as a company. One thing that sets us apart is that although we will lend on multi-unit freehold blocks, we will also lend on partial multi-unit freehold blocks. So to give you an example, if your client has a block of, say, 10 flats, for example, and so if it was a multi-unit block, say if they'd sold off 4 of them, so they were left with 6, we will be able to lend on that building, even though part of it has been sold off on long leases. So that's a market that we're good at doing. And we're seeing more and more landlords diversifying, releasing funds and releasing equity from their blocks, and we can still help these funds. High-rise flats, if the only thing that we insist on is going to be, I'm going to come on to Jatinder's question in just a moment, and she'll be there in a minute. So at high-rise flats, the only thing that we insist on is that we need a lift in that building. And also with ex-local authority, we can lend on ex-local authority flats. We can go up to 75% on these properties. But the one point that we make clear is that we would like the majority of that ex-local authority block to be in private ownership. So let me explain. When I say the majority of that block in private ownership, I am talking 51% or more. The reason we ask for this is because if we ever had to take possession of that property, and I hope we never have to, the onward saleability of that property must be clear for us. So we have examples of applications that come in or people that talk to us about cases where there's only 10 or 11% private ownership. It's very limited onward saleability of that property. You can't do these cases. Okay. And Jatinder, to answer your question, will you consider flats above commercial? Yes, we will. So the next point there is about property above commercial. So landlords do like property above commercial, and we will lend above restaurants. We can lend above takeaways. We can lend above off licenses. We can lend above a commercial unit that's potentially unknown at that point. And also property next to commercial as well. Okay? We'll limit LTV to between 60 to 65% as a general guide at this stage, but it is a big market for us when we are lending. Again, with flying freeholds, we're not inundated, as I say, with flying freehold applications. But if your client does have a property that they're looking to buy, and it does have more than 10%, refer the property into my team and we will review it for you. And 2 other points on this: corporate lets and unusual occupancy types. So it says on there things like DSS, students, vulnerable tenants. Okay? The one thing that we ask is that with these clients, we just have sight of that lease to make sure that if we ever need to take vacant possession of that property, we are able to. And I think Tony's going to give me a little nudge about time in just one moment, so I won't be too long. Oh, you're not? Okay. And the last thing regarding the things that we can refer, I mentioned payday loans earlier in my presentation. If your clients have recent payday loans, be it over 3 months old, but less than 12 months old, if they've been paid off and there's no shortfall and there's no issue with these payday loans, tell us why your client had them, because it's not an automatic no if they're less than 12 months old. We just need to know why they took them and what they were used for. So I've answered all the questions that have come through, okay? And what I've also done is actually, you've got the team phone number here for the buy-to-let team at Specialist Hub. Please do use these guys. We've got a good working relationship with Specialist Hub. They're a nice bunch of people. They're an honest bunch of people, and they'll find you the right lender for your cases.
Kitt, thank you very much. You've answered all the questions that were asked. You've done my job for me. Absolutely fabulous.
No problem.
Must get more to do that. We had a couple of questions. We haven't got a little bit of time, so we've got a couple of questions that some ones we came up with previously. What other products are available via West One?
So, as a company, that's a great question. Thank you, Tony. So, I mentioned earlier that the buy-to-let side was the newest part of West One. As a business, we've been operating since 2005. So, we will do things like bridging finance, development funding, second charges, and now buy-to-let. So we have specialist teams within West One that will cover all of these topic areas. And we have one phone number that you can call us on. But the one phone number I suggest right now is the 0800 number. Because of everything that Specialist Hub do, they've got links into West One that cover all of these product ranges. So thank you for that, Tony.
Okay, what Kitt doesn't know is that also West One, I've got, I think it's currently about 7 or 8 of my ex-staff working for them. From the late 90s and the thousands. So
I did not know that bit. I'll be honest with you. So
the relationship's already there. So as you can imagine, if I'm speaking to one of them, I'm not speaking to them as if they're unknown to me. They were on my payroll for quite a while. So
fantastic. Okay.
Next question I've got is actually that's already been answered. Why do West One do the ICR on interest only?
Yeah. So I mean, that was something that I mentioned previously. Thank you for that question, because we as a company would prefer ICR to always be done on interest only. The majority of our buy-to-let applications that come into West One are on an interest only basis. It's overwhelming. I think it's more than 90% of applications are on interest only. If a client chooses to go on a repayment strategy for their West One because they want to, close down and amortize their debt over 25 years, for example, we do not have a problem with that. And we also know that if that client ever chooses to, they can always switch to interest only in the future. So we do feel, Tony, that it's incredibly unfair on a client who's actively choosing to do a repayment strategy to then penalize them because they're doing a repayment strategy. So we're very comfortable with leaving our ICR interest only, and there's no plans to change that whatsoever.
Common sense, really, as far as I'm concerned. I'm surprised more others don't do it.
Yeah.
Really. Okay, Kitt, that's absolutely wonderful. We're slightly ahead of time, which is great because it means I can leave earlier today. So thank you very much indeed. Much appreciated. Great presentation. As I say, any cases you've got, they're doing a lot of stuff that others won't do. Anything you've got, we are an accredited packager for West One. If you don't want to give the advice, just chuck it over. We'll give the advice to the client. We offer both services. So the team are waiting, everybody. So if you've got anything you want to discuss, I'll kind of just ask a very sneaky final question, or 2 final questions actually. What are properties next door to one another?
So if they're buy-to-let properties, for example, next door to one another, as long as they're not next door to your client's residential home, then the answer is yes. It's very similar to lending to a client who's got 2 or 3 flats in a block, for example. So as long as they're on separate titles, that will not be a problem. And the second question there from Colin, I just snuck that in. Thank you for spotting that, Tony. Our apologies. Okay. He's answered his own question. I'll answer it for everyone else. Do West One appear on 27 Tech? The answer is yes, we do. And Colin's answered his own question.
Okay, they also appear on Commercial Quote, which is our own system that we use purely because we found that the sourcing services out there were pretty inaccurate at times. That's been quite kind. So we actually designed our own, which I'm going to talk about a little bit later. But they appear on ours, and you can actually get accurate quotes, and they're actually showing up when they should do, which I think is the main thing. So, Kitt, thank you very much. I'm going to switch on to our final speaker now. So,
very welcome.
I will speak to you soon. Our final speaker. So, again, I'm going to do my 5-second gap, everybody, just so that we can do our editing afterwards.
Excellent.
Okay, so on to our, I can count again. Okay, our full speaker, we have the lovely Sammi Gilbank from Hampshire Trust Bank. And there's a picture. I was actually looking at this last night thinking, I wonder if she's had her haircut recently, because it'd be interesting to see when she comes on, which she can be any second, I believe. She'll be with us. So there she is. Oh, she's got the hair up, I can't see.
I have, but
is
yes,
it still long,
I have had it cut. It's not as long as that, no.
Okay.
I took the opportunity between lockdowns and had quite a bit taken off.
I think I might just shave my head fairly soon as getting to the stage. Right, okay. So a little bit about, first of all, this is what you should receive via email today. So just check that. It's a double-sided document. So that will be with you. It doesn't include any rates or anything. They're available on our site. But Sammy's going to be talking about some of the bits and pieces during the presentation anyway. Okay, so just regarding Sammi, first of all, so she started her career in financial services all the way back in 1995 as a secured loan clerk for First National Bank, the lender of the cricket incident, by the way. She has progressed through various roles over the years, from administration to underwriting, has worked for other banks as well as direct brokerages on an advisory basis, and spent 10 years working as a packager. Sammi has seen many changes over the years, and the variety of roles she has held has given her an all-round understanding from a borrower, broker, and lender perspective. It's not all work. She has a passion for music. She's going to sing us a song in a minute, apparently. Listening, not playing. Sammi goes to many live concerts and loves the theatre, something she's really missing in these strange times. And her interesting fact is that Sammi has signed up to walk the 1,000 miles in a year challenge, all walking to be done outdoors. And she's currently on track, but a long way to go yet. Sammi, how many miles have you done so far?
I think I've done 72 since the beginning of January. So, yeah, a long way to go. But it's more difficult than you think, because you can't stop just because it's raining, because it's got to be done outside. So there's no cheating on a treadmill. So, yeah, but it's good because it gets you outdoors, which is what we all need at the moment.
Excellent. I think if I'd signed up to do it, I think I've probably done about 400 yards so far. So since New Year, so maybe not for me. Right, okay, everyone. So I'm going to just go on to the next slide, which will tell you it's going to start in a few moments, and then on to Sammi. It's all yours.
Perfect. Thank you, Tony. Okay, well, as Tony said, my name is Sammi Gilbank. I am from Hampshire Trust Bank. I'm here to talk to you about our specialist mortgage range of products. Everything that we do at Hampshire Trust within our specialist mortgages is all unregulated business. So as you can see from the list there, we've got our specialist buy-to-lets, semi-commercial, and then we also do a little bit of residential and semi-commercial bridging too. Probably a really good point to make at this stage in the presentation. Everything that I speak about really does reflect the true essence of what HTB can deliver in normal circumstances. There have been a few tweaks and changes to our criteria as a result of COVID. But if you speak to any of the guys at Specialist Finance, they'll be able to answer your questions and queries on our current appetite and where we sit at the moment. But as we're working through, if anything's slightly different to the norm of what we were doing previously, obviously I'll highlight that to you. So one of the things that makes HTB a little bit different, probably from some of the other lenders that share this specialist buy-to-let arena, specialist mortgages arena, is the fact that everything we do is very, very hands-on. So we understand that the types of inquiries and the types of business that you're going to be bringing to us are going to be complex in their nature. So that's why we like to have a really hands-on approach, all the way down from being able to speak to myself directly with any of your new inquiries to discuss at the outset and see whether or not we've actually got appetite, through to our regional lending manager who will help you construct that deal and put it all together. And then throughout the process, there's a dedicated case manager, underwriter, and completions expert to ensure a smooth end-to-end process. We do have involvement from the underwriting team, and they will happily pick up a phone and discuss a case with specialists at the point that it's been submitted for review if there's questions and queries to be answered, so that obviously we can get to the root of it very, very quickly and hopefully progress your cases in a timely fashion. So features of our specialist buy-to-let products. We currently have an innovative product range lending up to 15 million. Now that is per borrower. So that could range from lending to an individual, lending to a limited company or an SPV, or a combination of both. So once we've either had one deal in or 5 deals, as soon as we get to that 15 million pounds, that is our current lending limit. We can lend up to 75% loan to value, and arrangement fees can be added on top. Provided we've got the ICR cover for the gross loan, we're happy for those fees to be added. Currently, we have a no maximum age, and that's either at application stage or at the end of term. And we have no minimum income requirement for our borrowers. So that means we're happy to use income derived from a portfolio. We're not looking for additional outside income to top that up. And we only offer fixed rates. So it's a very simple approach to products. We've either got 2 or 5 year fixed. So the types of borrowers that we're lending to, it's a really broad, wide range. So we can lend to trusts and offshore companies. We will look at where that offshore company is located, and what we will do is look at the risk of that particular offshore country, where it is, and obviously underwrite that appropriately. There's not many that we'll say no to, but different cases require different amounts of due diligence. We can lend to brand new off-the-shelf SPVs, so there's no minimum time trading for those, as well as lending to trading limited companies. Now the trading limited companies that we lend to, again, no minimum time trading, and they don't have to be set up with any specific SIC code. So we can lend to any type of trading company. That would include builders or plumbers, merchants and the like. So no restrictions there. Portfolio landlords, no matter what size of their portfolio, we will be happy to lend either on a few properties in isolation or across the portfolio in total, if that falls within our lending limits. If we are lending to a portfolio landlord, we do stress the portfolio, and that's at 125% at 5%. We can lend to expats and foreign nationals. Now, obviously, that's expats residing elsewhere in the world. What they would need to have is a foothold back in the UK, and foreign nationals either residing in the UK or in their own country. And again, what we're looking for is a UK footprint. The UK footprint doesn't necessarily have to be a security here. It could be a bank account, it could be a UK-based limited company, but something that we can see they've already got that footprint in the UK. If we are looking to lend to an expat and they're currently living abroad, the only scenarios we can't consider would be if they're looking to refinance what was their former residence and they don't currently have any other buy-to-lets in the background at all. So if they just refinance their previous residential home, put it onto a buy-to-let and they don't own any others, then that wouldn't be a scenario that we can consider. We can lend to first-time landlords, slightly different to our standard criteria. What we're looking for here is for first-time landlords to be residential homeowners, and they must have a minimum income of 25k. That 25k is actually per application rather than individual. So if you've got more than one applicant on an application, as long as the combined income is 25k plus, we can consider lending. As I move on through the different property types that we'll lend on, there are a couple of restrictions for first-time landlords, so I will cover that off as we get to them. And lastly, you can see there, we will lend to individuals. So someone who maybe got 1 or 2 buy-to-lets, or potentially a first-time landlord buying their first one in their individual name. That's absolutely fine for us to consider. So along with all of those different borrower types that we will lend to, this covers off all the different types of properties that we will lend on. And again, this applies to our specialist buy-to-let range. So when you're looking at the rate cards, which you can find on the Specialist Finance website, you will see that specialist buy-to-lets and HMOs covers all of those borrower types that I've talked about, and will also cover all of these property types that I'm just about to run through. So new build flats, we can lend on new build flats, even consider high-rise ones if they're in a city centre location. One thing I would say is to just look out for any additional service charges that maybe come along with the slightly more the new build properties that you'll find in the centre of London, for example. The service charges can be quite high, and we would always look to net that off of the rent and then apply the ICR cover to the net rent after the service charge has been applied. Holiday lets, we can lend on holiday lets, and we're doing an awful lot of those at the moment, as I'm sure you can imagine. So for us, what we're looking for is a property that lends itself perfectly well to being holiday let because of its location, but doesn't have any restrictions on the use. So for example, it could potentially be used as a residential home let on a standard AST, but they're just choosing to let it as a holiday let because they know that income streams could be potentially much higher. In the current climate, where we are in another lockdown, there will be a lot of holiday lets that are currently left empty. So having that option to be able to flip it and let it on a standard AST just gives a bit more certainty for ourselves and the client that they would have a continued stream of income. With holiday lets, we can lend up to 4 to any one borrower, and that would either be as one transaction, perhaps they're looking to buy a small block of flats with 4 under one title, or 4 individual properties split across a couple of transactions. Purpose-built student accommodation. Again, this is your large built student blocks, halls of residence. We are far more cautious looking at these at the moment, just because a lot of them are empty where a number of students haven't returned to university. So what we're looking for there is a strong borrower, a good property with good ICR cover and a decent level of LTV. Potentially, you could have someone that owns an HMO and is letting it to students. So again, if there's no restriction and there's demand for those types of properties to be let to professionals in place of students, that's a really good one for us to be able to then take a look at and consider lending on. Brings me nicely on to HMOs. We don't have any restriction at all on the number of rooms in an HMO. So we can effectively do HMOs any size. What we are looking for is the correct licensing to be in place and for it to adhere to anything that the local authority deems necessary. For HMOs, we are looking to lend to experienced landlords. So we wouldn't consider lending to a first-time landlord for an HMO. They would need to have at least 12 months experience owning a buy-to-let in the background. Freehold blocks, we can lend on freehold blocks any size, so any number of units within a freehold block. Again, there's no restrictions there. And everything that I'm talking about, when you look at our rate cards and you see that we lend up to 75% LTV, all the borrower types, all these property types do fall into that. Serviced accommodation, again, that kind of falls alongside the holiday lets, although slightly less appetite for those at the moment, because serviced accommodation, that's where we're looking at apartments, again, probably located in a large city centre, London, Liverpool, for example, and a lot of those are going to be sitting empty right now. If it's Airbnb, but it's an actual holiday let and they're just using Airbnb as a tool for advertising the security, but it could be booked for a week's holiday, for example, those we definitely can look at. Sitting tenants, we're happy to lend on properties that have already got tenants in situ, and also DSS tenants. So we have no restriction if the properties are let and there are DSS tenants in situ. We would not lend, however, if the tenants are classed as being vulnerable in any way. So if they're on some kind of housing benefit or income top up, that would be fine. But if it's like a halfway house scenario where the actual tenants could be deemed as being vulnerable, that is where we wouldn't lend. We offer top slicing for low rental yielding properties. So again, you may have a large portfolio. Landlords got part of their portfolio in London where the properties are slightly lower yielding, and then another portfolio in the north which is high yielding. If there's surplus income from that other portfolio, we can look to apply that back to the security that they're bringing to us and use that to top slice and get them to the level of borrowing that they need. We can also look to top slice from other outside income, employed and self-employed, for example. Now I can see there's quite a few questions coming through there, so I'll just take the opportunity to run through some of those quickly. So first one there from Paula, what about if income comes from another country like a Norwegian pension income? In relation to lending to foreign nationals living abroad, we can accept that. The only time we can't accept income from another country is if we're looking to do the top slicing. So top slicing, all the income needs to be generated in the UK. And expats living abroad, we expect them to be paying the correct amount of tax on their UK investments, but obviously appreciate they may also be earning money elsewhere as well. The minimum income figure doesn't apply to expats, it only applies to first-time landlords. It would apply to an expat if it was a first-time landlord scenario. So that question was from Darren. I hope that answers that one for you. And another question here from Belinda. If the client has purchased a property, BMV, as needed work and now wants to refinance as a holiday let, does the 6 months ownership rule still apply? Client can provide evidence of work done, costs demonstrate uplift in value. Okay, so where they've purchased a property and they've actually renovated it and they've got it up to standard to be able to let it as a suitable property for letting, we would still need to have that 12 months experience if they're falling into the first-time landlord category. If they've already got other securities in the background, we can look to lend against that uplift in value. Question from Robert. Sitting tenants, does this include protected tenants? Yes, we can look at protected tenant scenarios. We have actually done a couple of those types of applications for specialists. Good example is where we had a multi-unit block. One of the tenants within the block was protected, all the others weren't, and there was enough rental from the other tenancies to cover the ICR for the loan that was required. So we were happy to look at on that basis. Okay, right, and moving on to the next slide. She says, bear with me. Okay, so 5.2 product. This is something that we launched towards the end of last year, and it was off of feedback that we were getting from our brokers about the types of products that we offered. Quite often we were asked to look at our 5-year fixed product because on the 5-year fixed, the ICR is calculated at pay rate, so generally we'll give a higher loan amount. However, we were being told that the clients didn't always want to be locked in to a 5-year deal because they may change their mind what they're going to be doing within the next few years. So we launched the 5-2 product, which is a 5-year fixed, having the benefit of ICR cover at pay rate, but only having a 2-year ERC. So it works well if someone has a security that they're looking to hold to generate income, whilst they potentially could have a planning application going through to develop that security within the next few years. On this 5-2 product, they can hold it on that 5-year fixed rate whilst the planning application is going through, and after 2 years would be able to exit from our term loan onto development finance and continue with their plan to potentially develop that security. Again, in this uncertain climate, we've got borrowers that may have been looking to sell some of their securities, but this is probably not the right time for them to sell. So on this particular product, they can have the opportunity to borrow against that 5-year fixed, but again are only tied in for 2 years and then could potentially sell it thereafter. Something else that we've launched, again slightly different from our standard buy-to-let rates, is lending up to 15 million at a 5-year fixed rate of 3.25%. So in our arena, it's quite a market leading rate. Now, the caveats for this are it is a maximum 60% loan to value, and it is a minimum loan size of $1 million. So from $1 million up to 15 million, we can consider on a 5-year fixed rate at 3.25%. And that does include the borrower types and the property types that I've already run through with you. So sitting alongside our specialist buy-to-lets, we have the semi-commercial product range that we also offer. Again, on this range, everything is manually underwritten, so your more complex scenarios we can consider lending on. Again, up to 75% loan to value. Fees can be added on top, provided that the ICR covers. We can consider multiple different types of tenants occupying the commercial element, and our fixed rates on our semi-commercial start from 4.8%. The main quirk to our semi-commercial proposition, and the reason that we're able to keep the pricing slightly lower, is that we need 60% of the overall property value to sit within the residential part. So for example, if we have a total security freehold value of 300,000, we need the valuer to confirm that 60% of that overall value is applied to the residential area, equating to a value of £180,000 in simple terms. So that works really well if you've got one commercial unit potentially on the ground floor and maybe 2 or 3 flats above. Probably doesn't work so well if you've got one commercial on the ground floor and 1 flat above, because it's very difficult to gauge whether or not that actually does fall within the 60-40 split. But of course, it's for the valuer to confirm and report back to us. I mentioned on the previous slide that there's a large number of commercial tenant types that we can accept occupying on the commercial side. And that ranges from, as you'll see on the list there, offices, shops, restaurants, takeaways, fast food outlets, beauty salons, hairdressers, funeral parlours and the like. It's worth mentioning, if you have someone who's looking to purchase a flat on a buy-to-let basis that's already been sold off on a long leasehold, but it is located above a pub, a takeaway or a fast food restaurant, then we can consider lending on properties located above these different types of commercial on their own. Currently, we're looking for the residential rent to cover the loan, unless you've got the commercial element occupied by a tenant that has continued to trade through COVID. So obviously we can look at those for you on a case-by-case basis. Just before I move on to the next slide, I've got some more questions here which I'd like to answer for you. So if we've got an experienced holiday landlord, would they still need to have a minimum ownership of property for 6 months in those circumstances? The answer to that is no. So if they've done works to a property, we've got no minimum time that they have to have held them before we can consider refinancing them. So that minimum time and experience only relates to first-time landlords. Do we have any issues lending to expats living, working in Australia? Buy-to-let refinance where they inherited the property in the UK? Possibly yes, if the property was occupied by a family member and they don't have any other buy-to-lets in the background. That unfortunately would be an issue for us. So Reza, hopefully that's answered your question for you. Question from Robert. What is the fee for the 5-year money at 3.25%? That is 2%. So arrangement fees across all of our 5-year products is 2%. And as I say, can be added to the loan as long as the ICR covers the gross loan amount. Again, question from Robert. Park commercial, do we lend on the full value in our example of the split that I talked about? Yes, we do. So we lend against the 300k value up to 75% LTV, as long as the split is 180,000 in relation to the residential part. So hopefully that's answered that question for you. And a question there from Belinda saying thank you. Sorry, not a question, just a thank you. Great. I'm glad that answered that for you, Belinda. So just coming on to the last slide here, pretty much, which relates to our bridging or our short-term loan proposition, which we're probably not doing so much of in this current climate. Where you would probably be using us for short-term loans is if you've got something like an auction purchase, so obviously they need to complete quite quickly. If they're looking to do a refurb and then maybe they're going to sell the property on, or they're looking to then hold it as an investment, or a traditional bridge where they just need to get the money out quickly, but potentially their exit's not quite lined up, ready to go. On our short-term loans, we can consider, again, lending against residential buy-to-let properties or semi-commercial properties as well. Rates starting from 0.55%, so we're quite keen on the pricing. We have a dedicated underwriter that specifically looks after our short-term loans and our bridging loans, just to move them through the process that little bit quicker. Dual rep on legals, which also helps to move the cases through much, much quicker. And we offer title insurance as well, which cuts down on that legal process, again, enabling the case to go through in a more timely manner. We have no ERCs on our bridging short-term loan products, just a minimum 3 months term. And 2% arrangement fee, as I mentioned before, again, that can be added to the loan, but we are limited to 75% gross on our short term, as opposed to the 75% net on our term loans. Sitting alongside what we're doing on the short term stuff is our refurb in term. So again, this is a new product, but it's not a standalone product. Our standard buy to let rates apply for this particular product. And what it allows is for the landlord to go in and do works to the security within the first 3 months of the term. So maybe they're looking to purchase a property, they know that it's a little bit tired, but it just requires maybe a new kitchen or new bathroom, repainting, new carpets, and doing with that within the first couple of months of ownership will probably enable them to get a better quality tenant and potentially increase the amount of rental that they could get. So you'll see from the list there, what we're looking for is a security that is habitable, but it just needs potentially some refurb or modernisation. Just light works to be carried out. Relet period of maximum 3 months. The borrower must be an experienced landlord, so we can't do this particular scenario for first-time landlords, and they would need to demonstrate the ability to service the loan within the time frame that they're doing those works, so within those first 3 months. And as I said, our standard buy-to-let rates apply. Quite often, it's not going to be the case that they're going to purchase that property and let it straight away, especially if they want to go in and do some of these works first. So that works really, really well for those types of scenarios. Okay, so just one more question there before I move on, again relating to our semi-commercial. So for the part commercial proposition, ground floor business has moved in and started up during COVID. Is that acceptable? And upstairs is a good AST. Where you've got a fairly new business that has moved in, Robert, and obviously not generating income maybe straight away, provided we've got enough cover from the AST rental, so from the resi part, then we can look to consider where that new tenant has gone into occupy on the commercial, and also if the ground floor was vacant. So if we've got a vacant ground floor, but again 2 flats above that generate enough income to cover the deal, that would work. And that's it from me. So just moving on there quickly, last couple of slides, an overview. 15 million borrowing, up to 75% max, no maximum age, no minimum income, and rates 2 or 5 year fixed. And lastly, how to submit business and get it through quickly. Just use the guys at Specialist because they do know what they're doing. But, you know, the more information that you can give to them, the better, and the quicker that it will go through. Any questions?
Sammi, thank you very much. Just one thing just to mention that since Hampshire Trust launched back in May 2016, we was one of the first brokers they brought on board. And I'm not sure exactly where we are at the moment, but we're certainly, I would say, probably in the top 3 of the amount of business written. We're now into the hundreds of millions of business written since they first started. We've honestly done absolutely stats. Sammi was our loan manager for quite a while and has known us for ages. And she's now our, not BDM, are you? Because you're now she's our national account manager. There you go, or key account manager. Seriously, if you've not used Hampshire Trust before, this is a company that is well worth considering. And again, they don't tend to show up on the Trigold of this world and the 27 techs, but we've actually incorporated all of their products into our own software system, which I'll talk about later. And at the moment, we've got deals going especially on the 3.25% fix for 5 years. One of the questions was whether you could take regulated tenancies. I think there's 3 regulated tenancies on that particular deal within a portfolio that we're refinancing. The flexibility that we get from them sometimes absolutely just amazes me. Really does. It's real common sense lending. Can't really describe it any better than that. Just common sense lending. The other advantage we've got is that the day before lockdown started last year, we took on somebody who came from Hampshire Trust Bank and has been invaluable to sort of guiding us through the sort of like some of the weird and wonderful ways that lenders work sometimes. So that we've obviously used as much as we possibly can. So that particular member of staff is able to speak to people sort of like personally, because she's got their mobile numbers on her mobile, so she can speak to them personally and just get guidance as to how to do something. What service turnaround times are, anything that she needs. That has proved to be an absolute godsend. Knowing somebody, having done that myself many years ago, gone from a lender to a broker, and knowing how a lender works was really just invaluable for me when I joined my first brokerage. So question-wise, we are about a minute or so we've got before I do my bit. So Sammi's answered that. So Paul has asked, Sammi, is the refurb in term a specific product with specific rates?
No, so our standard buy-to-let rates apply.
Yep. So brilliant product. So if you get something that isn't habitable, maybe because it's got a slight problem that needs sorting, you haven't got to bridge it and then put it on a term product. You stick it on that, and as long as the property's ready within 3 months, which the vast majority of them are, let's face it, then it's good to go. So it saves the client money. And Paula, sorry, okay. And then she's then so ignore me. I think you said standard buy-to-let rates. Okay. So do we need to inform you that a refurb will take place in the first 3 months, or is this a general point of criteria that you will allow it in all your standard buy-to-let products?
And no, you would need to let us know, because we would want to see a schedule of the works that they're looking to do, and also make sure that the value is informed of that as well, so that they're kind of viewing it on the basis that there are going to be works done to that property before it's let.
Okay. Sammi, wonderful as always. Thank you so much.
Pleasure.
I will see you very soon, hopefully face to face, hopefully very soon.
Fingers crossed.
Brilliant. If you have any deals that all of you have, and anything you're thinking, okay, need to discuss it with someone, give the team a call, speak to either Joe or Gemma, and they can run through exactly what Hampshire can and can't do. And again, all the information is available on our website as well. As you imagine, with a lender that we do that much business with, we do tend to give them sort of certain priority when it comes to certain matters, making sure our website is up to date, that type of thing. So please give them a go. Honestly, they are brilliant. Oh, just actually one other thing I just thought of, because one of the questions was regarding the fee, the completion fee. Standard completion fee for Hampshire Trust is 2%, but that can be negotiated down. But it just then means it's a hit on what we earn and then what we can pay to you. So as an example, we've had a deal recently that we've dropped. It's quite a large deal, but we've dropped the completion fee down to 1.5% being charged by Hampshire. They then pay us 0.5% less than they would have done in the first place. But it now means that the case is actually now better than the Barclays deal that the client's been offered. So we're just using that particular system to ensure that we keep the business. So give us a go on that, because they are a brilliant lender to have on board. And there's not a broker out there that knows them better than we do. Okay, Sammi, thank you so much. I will talk to you soon. Okay.